I've survived 3 financial crashes, and I'm about to show you the exact patterns that made me millions while everyone else panicked. You'd body S. 13.5% inflation, 19% interest rates, over 1,000 banks collapsed, $500 million in today's money gone. And I was 20 years old, completely blind to what was happening. Here's what nobody tells you about financial crashes. They don't happen overnight. The American dream. Everyone should own a home. They created programs to make it easier for people to buy, even if they couldn't afford it. Buying assets at 50 cents on the dollar. Let me take you back to the 80s. I'm fresh out of school. I don't understand economics. I don't see any red flags. Why would I? When you're in your 20s, you don't have wealth. You're not paying attention. But behind the scenes, the economy is imploding. 13.5% inflation in 1980. Think about that. Right now, everyone's complaining about 3% inflation. This was over 10% higher. And interest rates? 19%. I remember buying my first car with my parents. The loan was almost 20% for a used car. The federal funds rate hit 22%. Today it's 5%. Unemployment peaked at 10% in 1982. The country was bleeding. But here's the critical question. How does inflation drop from 13.5% to 3.2% in just 3 years? One way: raise interest rates, crush the economy, make borrowing so expensive that spending stops. This was called the Volcker effect, named after the Federal Reserve chairman. The money is the goal. The goal is to take the money. You understand? But you need to understand why this happened in the first place. To understand the 80s, you have to go back to the Vietnam War and Nixon taking the dollar off the gold standard. Both of these events had catastrophic long-term effects. The Vietnam War cost over $1 trillion in today's money. Where did that money come from? They printed it. And around the same time, Nixon decoupled the dollar from gold. Before this, the dollar was tied to gold at $35 an ounce. After Nixon, the dollar became a fiat currency. The government could print unlimited money. Sound familiar? It should, because it's exactly what happened during COVID. The government injected trillions in stimulus money. And we got massive inflation. Same playbook, different decade. So here's what happened in the 80s. All that excess money from Vietnam and the gold standard decoupling created runaway inflation. Depositors wanted higher returns because inflation was eating their savings. So banks started paying 12 to 15% on deposits. But the banks had existing loans out at 6 to 8%. You see the problem? Banks make money by borrowing low and lending high. But now they were borrowing high and lending low. The math doesn't work. Over 1,000 savings and loans collapsed over the next decade. This wasn't a quick crash. It was a slow, painful bleed that lasted 10 years. And here's the kicker. People couldn't refinance. As rates went up, loans matured, and borrowers couldn't afford to refinance at higher rates. Banks failed. Assets got liquidated. The government created something called the ITC, the Resolution Trust Corporation. Their job was to liquidate assets from all the failed banks. And where was I? Managing properties for those people. I learned the lesson, but I didn't have the capital to act on it. I had no dry powder, no cash, no network, but I paid attention, and that education became priceless. Here's the first lesson. The government will always print money. Inflation will always follow. And the Fed will raise rates to combat inflation. This creates cycles. Boom, bust, boom, bust. And the people who understand the cycle get rich. Fast forward to the late 90s. I'm in my 30s. I've learned from the 80s. I'm starting to make money. And then crash number 2 hits. The dot-com bubble. $10 trillion. Gone in just a few years. But here's what's interesting. This crash was completely different from the first one. The first crash destroyed physical assets, banks, real estate. Main Street and Wall Street both got hammered, but the dot-com crash, it only destroyed paper assets. Tech stocks, speculative investments. Banks were fine, real estate was fine. The Nasdaq peaked on March 10, 2000. It had risen 400% in 5 years. Then it popped, dropped 40%. Fortunes evaporated overnight, and I lost some money too. Not a lot, but enough to learn another lesson. Just a bet that the price would keep going up. Sound familiar? It's the same thing we saw with crypto, the same thing we're seeing now with AI stocks. Speculation without fundamentals, it always ends the same way. So what were the signs I missed? Banks were fine. Housing was fine. Interest rates were around 6.5%. Inflation was 2 to 3%. Unemployment was 4 to 5%. On paper, the economy looked healthy. So why did we lose $10 trillion? Because it was all funded by speculation. Growth without profits. Earning didn't matter. Fundamentals didn't matter. People piled in because everyone else was piling in. And when the music stopped, the wealth disappeared. This crash destroyed retirement accounts. Baby boomers who thought they were set suddenly realized they'd have to work another 10 years. Wealth? Gone overnight. But here's where it gets interesting. The government was terrified of deflation. So what did they do? They dropped interest rates from 6.5% to 1% in just 3 years. Let that sink in. To fix one crash, they created the conditions for the next one. Cheap money, easy borrowing, and that lit the fuse for crash number 3. The big one, the global financial crisis. By the time 2008 rolled around, I was ready. I had learned from the 80s. I had learned from the dot-com crash. And I was positioned to take advantage of the biggest real estate crash in modern history. Let's go back to 2003. The Federal Reserve dropped rates to basically zero, 1%. When money is that cheap, people borrow, and that's exactly what happened. People started buying homes. Prices started rising. But there was something else happening. Both Clinton and Bush were pushing policies to increase home ownership. Same policies, same rhetoric, same playbook. Home ownership rates went from 65% to 69.1%. That doesn't sound like much, but it represents millions of people. Millions of people who should have been renting, but were pushed into buying homes they couldn't afford. If you were a landlord during this time, it was brutal. Anyone could fog a mirror and buy a house, so rental demand dropped, but that was about to change. By 2006, the bubble peaked, and then it popped. Hard. All those people who bought homes they couldn't afford, they defaulted. 3 to 5 million foreclosures. Homes flooded the market. The MLS was drowning in inventory. And prices collapsed. In bubble markets, prices dropped 50%. In most markets, it was a 25% correction. But the entire nation adjusted. Everything And here's what happened next. Those millions of people who lost their homes, they moved into rentals. Home ownership dropped from 69% to 63%. That 6% drop represented 8 to 9 million people moving from single-family homes into apartments. This is precisely when my partner Ross and I started buying multifamily. The market was broken. Sellers were desperate. Banks were distressed. And we had cash. We bought a 680-unit property in San Antonio in 2010. Lender-owned, 50% vacant. It needed millions in renovations. But we knew what was coming. We knew all those foreclosed homeowners would need somewhere to live. And we were right. We bought it for around $20 million. After we stabilized it, it was worth over $40 million. We still own it today. It's worth significantly more. This crash lasted about 10 years. The peak was 2006. The trough was 2016. 10 years of opportunity if you were positioned correctly. And here's what the environment looked like. Inflation was 1 to 4%, not terrible. Unemployment peaked at 10% in 2009, then gradually improved. And the federal funds rate went to 0 in 2008. 0% interest rates and a massive real estate correction. This was the signal to load up. And we did. But here's what most people don't understand. Banks weren't lending and American investors were scared. So where do we go? Canada. From a Canadian perspective, the US looked like it was on sale. Real estate had crashed. The Canadian dollar was almost equal to the US dollar. Interest rates were near zero. It was a bargain. And that's exactly what happened. Foreign investment poured into the US. And that foreign capital helped fuel the recovery. Here's the lesson. Investing is 10% math and 90% psychology, and it helps if you're working with operators who have lived through multiple cycles, who understand the patterns, who can read the tea leaves and know what's coming next. I've lived through enough cycles to know that when the headlines are the worst, the deals are often the best. You have to be willing to take calculated risks to look like a genius later. And that brings me to today. Right now, in 2025, I'm seeing the exact same patterns I saw in 2006 and 2007. Distressed assets everywhere. Loan maturities being repriced at 30 to 50% discounts. Sellers in trouble. Banks pulling back. This isn't about predicting the exact bottom. It's about recognizing that we're in a correction right now. The opportunity is here. And we have a president trying to push interest rates as low as possible. If rates drop and real estate is already discounted, what happens next? Price appreciation. Just like it did after correction 1, 2, and 3. We're actively evaluating distressed and mismanaged assets every single week. Properties that are 30 to 50% cheaper than they were 3 or 4 years ago. And we're buying. If you're an accredited investor who understands cycles, who wants to invest alongside operators who prioritize cash flow and capital preservation, there are opportunities coming. Big ones. The playbook hasn't changed. The government prints money, inflation rises, the Fed raises rates, assets crash, then they lower rates again, and the cycle repeats. The question is, are you going to be ready this time? Or are you going to watch from the sidelines like I did in the 80s? Because I can tell you from experience. The people who act during crashes build generational wealth. The people who wait miss the opportunity of a lifetime. If you found this valuable, subscribe for more videos breaking down real financial patterns.